Today our first presenter is Mr. Guy Churchill. Do we have you going or Kevin? Okay, I am the other way around. All right. So our first presenter today is Mr. Kevin O'Shea. Is a development specialist at the Hawaii Public Housing Authority. He has been in real estate since 1986 with such firms as the Related Group, Guardian Life Insurance Company, J.P. Morgan Chase, Lehman Brothers, and Wells Fargo, the latter two in Seoul and Hong Kong, respectively. Kevin will present on housing financing from the perspective of a state agency.
Close. Maybe not.
Or Kevin will present what Kevin wants to present today. All right. So, you ready?
Sure.
Okay.
Hi, thanks very much for that, Tonga. First and foremost, before we begin, I really, on behalf of the agency, we want to thank Senator Chang for having us all here today. Fellow housers, we're all housers. We think what he's doing is commendable. The problem is massive, and it's going to take big outside-the-box thinking. So we commend Senator Chang for thinking big and thinking big outside the box. When Senator Chang asked me to participate in the conference, he asked me to think about how do developers finance large real estate projects. And I started to think about some of the things that were important in that exercise. I'm trying to figure out how we work the button and talk through this at the same time. Here we go. And so what I thought I'd start with is the Black-Scholes model on valuing puts and options. No, I'm just kidding. I went into real estate because the math is really a lot more simple than that. A lot of it, multiplication, addition, subtraction, and occasionally division. When we create value in real estate, what are we doing? We're creating income, less expenses, that results in a net operating income. We apply a cap rate to that, and that gives us value. When we are creating or selling condominiums, we have a sales price, less a construction cost, less our finance costs, and hopefully we result in some profit at the end. Important things to consider when we look at how we finance these projects. Generally, there's a large component of equity. And then there's debt. Usually that ratio might be 20, 25%, 75% debt. As the projects get bigger, there might be some mezzanine component in between the equity and the debt. As the projects get really big, there's lots of different structuring that takes place. There might be developers' equity, preferred equity, mezzanine lenders, and if it's a really large project, maybe a big chunk of syndicated debt. We'll get to that in a minute. The important thing to remember in that structure is it's kind of upside down when deals get upside down in terms of who gets paid first. The syndicated debt would get paid first, then your mezzanine lender, then your preferred equity, and then your developer. When I was thinking through what are the important aspects of financing really large projects, the thing that, and I got all this gray hair for a reason, the thing that stood out to me was, these projects run 10, 12, 14, 15 years sometimes for a complete build-out. And through that process, we run into lots of cycles. I started my career in the early 80s, and when I started, I was a bright-eyed, bushy-tailed analyst, and I just thought the world was my oyster, and it was blue sky on the investment horizon as far as I could see. And then we had the savings and loan crisis. Right? How many of you remember the savings and loan crisis, or even know what a savings and loan is at this point? Right. The savings and loan crisis started in 1986, and it didn't end until 1995. And the thing that I remember the most was Sam Zell making a statement, stay alive till 95. That was almost a decade, right? And that was clawing, scratching, working your way out through deals to kind of stay alive. In 1995, after the dust had settled, I think 1,200 of 3,200 savings and loans had failed across the country. One significant reason for that was that crisis was propelled by a lot of developers and savings and loan officers making big financial contributions to the political campaigns of a lot of politicians throughout many states as a result of some some robust campaign finance reform over the last few years. We don't have that issue anymore, which is a good thing. That was meant to be a joke. So things were hunky-dory for a couple of years. We did well. I moved to Wall Street because I had a workout experience because I had done nothing other than that for the last decade or so. And then in 1998, we had a new crisis. We had the Russian debt crisis, and we had long-term capital management blow up. So you could hear crickets at the cubes on Wall Street. There wasn't a whole lot going on. I took an opportunity to go out to Asia because there was nothing happening in New York, and I went to Asia for what I thought would be a 4-week stint. I ended up staying there for 14 years of my life. The reason that we went was to help Asian financial institutions work out their credit. We extolled the virtues of deleveraging their balance sheets by selling off non-core assets. We bought significant not-performing loans, and then we developed a business over the next decade or so that was our traditional business that we ran in New York and in Wall Street. And I recall distinctly in I think it was 2006, 2007, our colleagues in our fixed income department would fly in, they would fly in for the evening, and they were selling collateralized debt obligations and resecuritizations. And the interesting thing about these guys was they always had 2 Blackberries. They had one on each hip. It was almost like they were, 6-shooters. And I would ask them about the CDOs and the structures, and the questions I would ask were, if this thing blows up, what happens? How do people get repaid? I just couldn't understand how it worked, and I was a debt guy. And they would, look down at their Blackberries, and they would never look up, and they would say, Kevin, you got to think about it like it's a 100-year flood, and we're in year 1. And fortunately, nobody looks down at their Blackberries anymore. They look down at other things. So the next year, we had the Asian financial crisis. Fast forward 100 years, and the whole world blew up. And the 2 things that I remember distinctly about the Asian financial crisis were, A, all the Asian companies that we advised when I was out there were now advising American financial firms on how to deleverage their balance sheets by selling off non-core assets. The other thing I recall is that you could pick up a BlackBerry for next to nothing. I worked on, while I was in Asia, and now to show you what a genius I was. In 2007, I worked on a transaction with Wachovia Development Group, who I represented. And we did one of the largest 99-year lease condo developments in Singapore. It was a 1,700-unit transaction, and it was multi-year. It was almost, I think, 8, 9, 10 years full build-out. Zaha Hadid was the lead architect. She was, at that time, a starchitect. She was one of the highest-paid architects in the country, in the world, for that matter, which I can personally attest to because I signed off on the bills. And it was a massive project, 1,700 units. We were in that transaction. I think we had an $80 million initial equity investment. And our partners were the Morgan Stanley Real Estate Special Situations Fund, Capital Partners, and the development partner was Capital Land, one of the largest, most well-respected, best-financed development partners in Asia. The challenge that we had was, in 2008, we had the financial crisis. And so the reason I bring all of this full circle is that in that transaction, we were compelled to move forward. We really couldn't get out of the deal, if you will. And right at the heat of the financial crisis, I had to go back to our bank and basically tell them that they needed to invest another $38 million, which during the heat of the financial crisis was really like pulling teeth. There were 13 original lenders in the bank syndicate. 5 of them pulled out. We had to restructure our debt, put more equity in. We had to resize all of the units, work with the architect, to restructure the deal from soup to nuts, from the bottom up. At the end of the day, it worked out. Wells Fargo had acquired Wachovia. They had written down the asset to zero. After the full build-out was completed, they got paid back not only their full principal balance, which was, I don't know, 125, 130 million at the time, but then way more at that time, so it was a massive home run for them. But the takeaway for me was, in these large-scale developments, the thing that we've got to keep in mind is that life is cyclical. The business cycle is cyclical. And in order to have a successful project that big, you've got to have a really well-capitalized, well-respected development partner. You've got to have limited partners who are committed to the project, and you've got to have lenders who are flexible. And that was my big takeaway. And I think the Guy and Jeff are going to talk a little bit more about specifics of doing large-scale transactions going forward. Thanks, Phil.
Wonderful. Thank you, Kevin. All right, so as he mentioned, we're going to be moving on. Next, joining us on the screen, he is dialing in or Skyping in from Los Angeles. Hey, Jeff. All right. We have Jeff Yamashiroya, principal at Blackstone Group in Los Angeles. Mr. Yamashiroya's primary focus is on asset management of various investments in the office and senior housing sectors. He is a local boy in 1997, graduate of Aya High School, and holds a master's in real estate from Columbia University. Mr. Yamashiroya will share with us some examples of privately financed housing projects. And I will give it to you. Is he on? 1 second. Can you hear us? Can we unmute? One more time. Okay. Test. Okay, so while we get him online, do you mind if we're going to move to the next panel, if that's fine, while we get the AV working so we can hear him? All right, so we will be moving on to our next presenter. So our next presenter is Mr. Guy Churchill, Executive Vice President and Manager of Commercial Banking Group at Bank of Hawaii. Prior to his position, he was a Senior Vice President and Team Lead at Wells Fargo, managing commercial real estate in Honolulu. He will discuss private sector financing from the perspective of a private developer in partnership with the state. Thank you, Mr. Churchill.
Thank you. Can you hear me? Okay, great. Thank you very much for having me. So I am going to spend a little time talking about financing from a private sector perspective. Coming from Bank of Hawaii, we financed a number of high-rise condo towers. And so what I'm going to do is put together a hypothetical illustration of really what a feasible capital stack might look like in a project that is of large scale. Maybe show a little bit about loan terms, what that might look like, and then some other key considerations for a private developer and a private financing. So in terms of the first few, I guess, key critical aspects that a bank or lender might look at, there's really three main things, starting with the developer. How competent, how experienced is a developer? Second, project team, looking at really, do they bring expertise? Have they worked together? Such as, an ACK being a prime example of a high caliber contractor. Those types of things are key considerations. And then demand. Obviously, we understand that there's a big gap between the supply and the demand in the market. Unfortunately, from a bank standpoint, we've got to convert that demand on paper to actual binding sales contracts in order to get lenders comfortable. So you guys are probably all familiar with the movie Field of Dreams, when the voice says, if you build it, they will come. In the world of project finance, it's the opposite. If they come, you will build it. So critically important piece of it from our perspective. So just a quick, this kind of mirrors, Kevin's presentation a little bit. One nuance is slightly different, which I'll get to in a little more detail. But essentially, the capital stack looks somewhat like this. And again, this is a generic snapshot. The developer equity is the first capital in, generally in the 15 to 20% of total project cost. In the middle section, which wasn't in Kevin's presentation, but it's something that's really, really important here locally, and that's the buyer deposits. We have a very developer-friendly condo law, which allows buyer deposits to be used to fund construction. And this has been really, really important to help getting a lot of projects done because it minimizes the developer true cash equity. That's generally in the 5 to 10% range, sometimes larger. When you see larger projects that have, bigger down payments of 15, 20%. In the case we're talking about today, it will be slightly less. The last piece being the bank debt, and it's generally 70 to 75%, sometimes less, could be more, and we can talk about those things a little bit as well.
Can you hear me now?
Okay, so in terms of what a hypothetical project might look like, I'm gonna do it.
Now I can't hear you.
I'm gonna build to what the financing structure might look like,
okay,
starting with what we know. And I'm gonna assume a tower that has 700 units. And then I'm gonna assume a $300,000 sales price, which is what the target price is.
Can you hear me?
Senator Chang's model. So from that, you can see 700, 300,000, we get 210 million of gross sales. When you back out selling costs of about 7% generally, you get a net sales of 195 million. Generally, developer might be looking for about a 30% return on cost. This number varies depending on who the developer is, what the risk profile is. It could be in the range of 25 to 35%. For this demonstration, we're going to assume a 30% return on cost. That's 45 million. So what that does is back into a total project cost of $150 million is what it would need to cost, kind of, let's just say max, for me as a developer to want to go build this project at this kind of sales revenue. So we assume that 150 million of cost, and again, we talk about 75% bank loan. That's a $112 million loan, generally speaking. Now, banks might like to see about a 1.2 times coverage in terms of pre-sales, and then we're talking about net sales to cover their loan, to give them certainty that there's enough demand, enough sales to get paid off, essentially. So that's that number. We get to about $135 million of net sales, okay, in order to retire our 100 back to selling costs to get to a gross sales of 145 million. And again, our one constant here, $300,000 per unit. That means we've got to sell 484 units in order to achieve this sales number to make the bank comfortable. That's about 69% of our 700 unit tower. Everyone with me so far? Okay, good. So moving down to the bottom here, so we take this 69, 70% sale requirement, and that equates to that 145 million that we saw up here. And we assume a 5% down payment. Now, generally, these down payments can range from 10% up to about 20% is more typical. In some cases, we've seen 50% down payments in some projects. But for this purpose, we're generally in that 3 to 5% range is the target in order to allow more affordability on the down payment. So if we assume 5%, we get a buyer deposit of about 7.2 million. So keep that number in mind. So from there, we want to build this capital stack and demonstrate what it's going to take to fully finance this thing with equity, debt, and deposits. We talked about a $112 million loan at 75%. We layer in the deposits of 7.2 million. And what that means is there's about $30 million of equity that's needed to build this project. Now, if you're like me, the reaction to that is, wow, that's a lot of money. There's not a lot of people that are sitting around that have $30 million that can go out and build these projects. So there are other factors that could play in. One of that is mezzanine financing, which I'm not going to get into here in detail. That would help alleviate some of that equity burden. And the other thing is potentially some credit enhancements, which we'll get to in a second. This is a generic look at what loan terms might look like in terms of the financing. On the debt side, generally 3 years, up to 75% of cost. A generic pricing grid there in terms of spread and fees, pre-sale requirement. Generally 60 to 70% is the ballpark, interest-only loan. And then the guarantee piece of it, that can help determine what your debt load is, whether it's non-recourse or full recourse financing. So just some considerations. Again, government, I would say that if there's a willingness for the government to provide some sort of guarantee, that can help drive the leverage possibly up to 80, 85%. So it's not actually government funds, right? Because again, we're trying to do this without any kind of subsidy. But if there's a willingness to put guarantees, that could increase the bank debt, which decreases the developer equity, which makes it more likely that these projects will have desire to get built from the developer standpoint. Capacity, I think, will there be enough appetite from the bank market? If we're talking about 6,000 units a year, that is significant, obviously, new supply. Hard to say if there's enough bank appetite, so something to think about. And then, of course, labor. I mean, if we're talking about 6,000 units, which could be 8 to 10 towers, how do we, per year, how do we have enough labor to satisfy that, which is certainly a concern. And with that, I will, I guess we'll save Q&A for the end.
Yeah.
Thank you.
Thank you, Mr. Churchill. So I have good news. We're able to get Jeff online, and we can communicate with him.
Hi, everyone.
Yes, perfect.
So the beauty of going last is I just have to echo what all the previous presenters have just said. So this won't be too long. I've been working at Blackstone in the real estate private equity group for the past 7.5 years. I was based out of New York for more than 8 years, and I recently moved to Los Angeles a couple months ago just because I wanted to be closer to home, which is Hawaii, where I was born and raised. Before I start, just a quick caveat. At Blackstone, we don't do development. That's not our bread and butter business. Aside from the lending business that we have, our bread and butter business is buying distressed assets, repositioning them, and then selling them. However, we have invested in leasehold structures before. And leasehold structures, as you all know, it's been around since the Middle Ages. Leasehold condos have been very prominent in Hawaii for a very long time. It's very common in the UK, Hong Kong, Singapore, as people mentioned, New York. And as I mentioned, Blackstone has acquired assets with ground leases. We just did one recently, actually, in Hawaii, the King Cam Hotel on the Big Island, which is on a leasehold. I would say I haven't seen a lot of ground-up leasehold condo developments recently. However, I can point to one example, which is Bedford Union Armory in Brooklyn, which is a public-private partnership development, which I foresee this happening here as we contemplate this leasehold condo structure. Part of that development at Bedford Union Armory will be affordable leasehold condos. So just talking about financing here, all your usual characters finance leasehold structures. It's nothing new. Banks, securitized lenders, insurance companies, debt funds, mortgage REITs. It obviously would probably come with a wider spread, costlier financing than fee simple, just given the risk of term and ownership. Financing rates could be 300 to 500 basis points higher than fee, or might have a lower loan to value ratio depending on the term. So for a leasehold condo development, given you don't own the land, which is usually a third of the project cost, the bank's collateral would have to be the developer or sponsor group's equity. So you don't have a hard asset to collateralize because nothing's been built yet, unless the state is willing to allow collateralization of the land, which might be complicated. So you're looking at the bank probably loaning at about 50% of the total construction cost. Now, if it was a $30 million development, that would mean a developer would have to put in $15 million. That's a lot of money, and it eats into their returns. So you would probably have to rely on a public-private partnership, which is not atypical, and there are financing programs, government financing programs and tax incentive financing that can make up 10 to 20% of the capital stack. I believe recently San Francisco has a Prop A on the ballot, and I think it's like a $600 million bond that would finance the construction of affordable housing. So there are public-private partnerships in the works. And I think someone mentioned before, one way to offset capital needs is to use pre-sale hard deposits. I'm going to skip the next slide, which is key elements for financing. I think it's very legal-centric here, and I'll just talk about the risk. So I would say the risks here are the leasehold stigma. Since I've been growing up, there's always been a stigma of owning leasehold condos. I think the preference is fee, obviously, but, it is very common and commonplace. So there are demand for this, especially now in an economy where, I would say a lot of millennials can't buy homes. I think that's a huge concern in the future. And the homeless population is growing, not just in Hawaii, but in Southern California, Northern California, New York. Seattle's up and coming on that. And I think you're seeing a lot of companies that drive the GDP of that state/city are participating in something affordable or affordable housing development, like Google just announced something recently. So just going back to the risks here, I think you have to see if it's lucrative enough for a developer. If I did some simple math here, if we were building 100 units and each unit is like 600 square feet, you're probably building a 75,000 square foot building, including amenities at a construction cost. I think it's around $400 today, $400 per square foot. So that pencils to a $30 million project cost, which I mentioned earlier. A bank may fund 50% of that, so a developer would obviously have to come out of pocket $15 million or get some sort of government help in financing. And let's say you sell condos for $300,000 on average. This probably equates to $30 million of gross sales, which is the same as the project cost. So there's slim to no margins, right, unless you're banking on developer fees and or help from the government, for example, lower sales tax and construction-related product. But it does work if it's scalable. So if you did the same math, but you added 300 units versus 100 units, and your construction cost should come down on a per square foot basis, and your average condo sales are still at $300,000, you get an $11 million profit. So I think this is really about two things. One is scalability, and then second, it's about public-private partnership. And I think it is doable. And the last thing I want to touch on is sizing the ground lease appropriately for the condo buyer and having future transparency on the reset. For example, if there's a reset on the ground lease every 25 years, you would want to know the math behind that in the agreement and prepare accordingly. I would say in terms of sizing the ground lease payments appropriately, for example, if the ground lease payment for a condo owner, if you bought a condo for $300,000 and your ground lease payment is, for example, $300 a month, which you pay with your HOA dues, your insurance, tax, and mortgage, this total monthly cost could equate to $2,000 a month. And that could be the same as if someone was buying a $500,000 fee simple condo, which sort of negates the affordability. So I think in terms of the public-private partnership, this is one thing to sort of talk to the city or state about, or the municipality to see what that right rate is. And it could be, $100 or even less. And last but not least, I would say for the condo buyer or owner, resell and financing options are somewhat limited closer to the end of the term. So those are, some of the things that we need to think about. Just to wrap this up here, I'm a strong believer in trying something new, and especially if there's a template that's used somewhere else successfully, definitely open to that. So I really appreciate you guys inviting me to this brainstorming session.
Perfect. Thank you so much, Jeff, for joining us all the way from Los Angeles. And so at this time, we're going to take 5 minutes.
Hello?
Yes. 5 minutes to take Q&A. Is that good? So we'll take questions from the audience if anyone has questions. Something that I was thinking about, I was part of the delegation that went to Singapore and Hong Kong with Senator Stanley Chang, and one of the mechanisms that just astounded us was how Singapore was funding for their affordable housing. And so they were using in essentially their retirement. And that's something that I was trying to figure out. I work on legislation for my senator, is, we have the ERS, the retirement savings here. Would it be a possibility for workers or even their 401k to utilize that as a down payment? Or is there such way that system can work here in Hawaii? So using your retirement as a down payment for your leasehold. That was just a
Hello?
question.
Is this on?
So in Singapore, what the government allows workers to do is basically tap their retirement program. It's almost the equivalent of tapping your 401k, and so you can use those saved earnings for deposit on your home. And it's a great program. We could do it in the state, but we'd have to get federal cooperation, obviously, because 401ks are taxed at the federal level. But it's something that could definitely be looked at.
And so we have a question from John. How many banks and other financing companies in Hawaii can finance a big condo project, as well as how many developers have the necessary financial resources?
Yeah, I think it's a great question. I would tell you that there's 4 primary banks in our market that finance this type of thing. We're small banks, right? So that's my comment earlier in my presentation, was capacity and appetite. There's only so much the local banks can do. So certainly it would require some additional, bank funding outside of our market. What that number is in our market, hard to say. Maybe it's, per project, it's in the $100 to $150 million range, just the local banks. But it can only do so many projects, right? Because it just taps out. I think the second part of the question was
How many developers?
Yeah, how many developers? Yeah, I would tell you that there's probably, you can count them on 2 hands, right? I mean, there's really the groups that are doing things in our market today that have shown the capability to execute on their, large projects. So I would say, yeah, a dozen or less.
Any more? We have a question from the audience.
Yes, as a follow-up to that, being able to count on 2 hands how many developers work in town, what do you think would help create circumstances in which more developers from outside would be interested in jumping into the pool?
Hello, Jeff. Thank you. Do you want to jump in, Jeff?
Go, Jeff, you want to jump in?
You can take it, guys.
I would tell you that it comes down to how favorable the financing. Jeff, can you hear us? No. I think to incentivize more developers to either enter our market or do this type of project, right? It's going to come down to how attractive the financing is going to be, to be honest with you, right? If you have to come up with 5 or 10% equity versus 15 or 20% equity, that is a game changer in terms of your interest in doing a project and looking at the profitability and what kind of return you want to have for the risk. So I do think that, the government's role in some sort of, credit enhancement to allow the banks to want to lend at a higher leverage is an important piece to this, especially since, the deposit structure that we're talking about on these deals is really small. I think 3% was the target. I used 5% in my illustration. 15 to 20% is commonly seen in the market, and that is a huge slug of the overall capital that's needed. And so when you don't have that additional capital to help out the developers, and it's more true cash equity, makes it more challenging.
I can jump in on top of it. If you wanted to think really boldly, just because it's a brainstorming session and we're kicking tires, what if the state were the developer? And eliminating, a 30% underwriting profitability. And what if we passed legislation that allowed deposits to be used for construction up to perhaps 80%? That would eliminate the state needing to basically issue bonds to cover the construction. The state would be stepping in and assuming the moral, responsibility anyway for repaying those bonds. But it would eliminate a lot of overhead cost. But the challenge would be, does the state really want to be in the construction business? It's a big enough problem that we probably want to be thinking about it, at least. And it's not like we're putting developers out of business, because there aren't that many that are big enough here to begin with to bid on these jobs.
That's great. That's great. We have another question from the audience.
Guy, what was the cost per square foot and unit size in your example, and would those be realistic?
Yeah, that's a great question. So I assumed about a $300 a foot cost. I think it's in the ballpark, and I think we're fortunate that we're going to hear from a couple of pretty experienced individuals in about 30 or 45 minutes that could maybe shed some light on that. But I think it's something that is in the ballpark from what I've actually seen in the market. Not so much recently, so things maybe have moved, but it assumes about $300 a foot in terms of hard costs. Close to 400 in terms of total cost at soft and financing and other things like that. And that's about a 550 to a 600 square foot unit.
Thank you, Guy. And with that, we're going to close out this panel. If there's any more questions, they will be here today, so feel free to grab them and ask about where's the money. Just kidding. But thank you, Guy. Thank you, Kevin, for joining us, and Jeff as well. And now we'll transition. Thank you.